SBI Cards IPO opens for subscription today. The much-anticipated primary offer will see two shareholders, SBI and CA Rovers Holdings, reduce their stake. 74 anchor investors have already bought about 3.67 crore shares, perhaps a validation of demand for this IPO. Shefali Malik is here to take us through the details. Shefali, much sought after, finally kickstarting today. Give us the details.
Yes, starts today and ends on March 5, so a 4-day IPO, usually longer than the 3-day because of the anticipated demand. And then the price band has been set at 750 to 755 rupees. So at the upper end of the price band, the market cap works out to be around 70,000 odd crores, and the issue size works out to be 10,340 crores, again at the upper end of the price band. So fresh issue is for 500 crores, that is 66 lakh shares will be issued, and offer for sale for 13 crores shares, so that will rake in 9,850 crores. So the shareholding pattern pre-issue, SBI currently holds 74%, that will go down to 69.5%, and CA Rover Holdings that holds 26%, that will go down to 15.89% in the public, or the IPO subscribers post the issue will hold 14.6% in the company. And how much can the various stakeholders subscribe to the IPO? For QIB, that is qualified institutional buyers, 50% has been reserved. For non-institutional buyers, 15%, and retail 35%. This is obviously after some reservation for employees and the shareholders, employees of SBI Cards and shareholders of State Bank of India. So some quick facts about SBI Cards. It is the second largest credit card issuer in the country, has 18% market share in terms of the cards issued, again 18% in terms of the credit card spends, and over last 3 years it has the credit card spends with SBI Cards has grown at a CAGR of 54%, and the number of credit cards outstanding have grown at a CAGR of 35% over last 3 years. That is much higher than the industry average. Also, another interesting fact about it is that it has highest number of co-branded cards in the industry. And again, how a bit more about the business model of the company, how it earns its revenue. Roughly 50% comes from the interest income and 50% from the fee and other income. And fee income also has 3 components. Spend-based income is 51%, instance-based is 34%, and subscription-based is roughly 15%. So that's a breakup of the fee income. And one fact that the management has been highlighting, that it has a very diversified source of client acquisition. So as on December 2019, through open market, it acquired roughly 51% customers, through banker channel 48%, and corporate distribution 0.4%. So the interesting fact about the corporate distribution is that the number looks small, but in terms of the spends that happen through corporate channel, that is much higher. So that is one interesting fact which we did highlight earlier. And so those are some of the basic facts about the company.
About the issue. Now, what about the financials, Shefali?
Well, that is another key strong point for the company, that they have a demonstrated track record of very strong show when it comes to the financials. So over FY 17 to 19 period, their revenues have grown by 28%, profit by 32%, and despite being having an unsecured nature of the business, the asset quality in terms of NPAs looks very minimal. Gross NPAs at 2.47%, net NPAs 0.8%. Now that's obviously because when it comes to the interest income element, the amounts dues by people keep on getting revolved or carried forward with minimal payment. So because of that, the NPAs probably don't reflect. And as such, the retail asset quality has not been too much of a pain point as of now. And apart from that, their return ratios are the key highlights. The return ratio at the end of December quarter was 6.7%, return on equity 36.5%. Now that is way higher than the industry average of, let's say, return on assets of 3.5%. So probably there's one HDFC Bank which is making in excess of 6% ROA. That's what I learned from my interactions with various analysts and other stakeholders. And apart from that, what are the key strong points and the weaknesses for the company? One of the strongest points is, of course, the strong promoter backing of State Bank of India, diversified customer acquisition channel, that it's not just 50% is roughly coming in from SBI and the rest from the open market channel. And what are the key concerns? What is a strong point is apparently is also a weakness, that there is that 50% dependence on the parent. And apart from that, the regulatory intervention on charges such as MDR, a cap on MDR fee, and also in some of the countries even the interest element is also capped. So that can also be a concern at maybe a couple of years down the line, probably. Unsecured nature of the portfolio and competition from, of course, the likes of UPI, wallets, etc.